I want to get moving just because I'm hungry and I can't have dinner until this talk is over. Although there's been more than one occasion where I have ended up making a meal of the snacks that are out there. Although Beth puts them away by the time, this talk gets started, and then the snacks are already away. Although keep in mind, you can usually get the previous day's snacks the next day in the lounge afterwards too. So Dr. Hoofnagel is usually emceeing the ceremonies here, but since the guest is somebody that I kind of contacted, or actually Bob contacted me again saying, hey, I'm title liaison, academic liaison for the Society of Actuaries, maybe I should do some liaisoning too. So he was kind enough to come back. But so I'll be introducing Bob today. Hi and welcome, I'm Doug. I work here, and many of you know me as a stat data sciencey sort of person. Most of you know me because I'm extorting and bribing you to be here as part of my class. So thank you for that. I'm delighted to introduce Bob Weishaar, to welcome him back actually. Is this the fourth time maybe? At least the third time. Third, okay, yep. And he's been kind enough to come back to spread the good news again about careers and opportunities, especially in that scene between the quant world and the world of finance and business and insurance. And I suppose you can read a little bit about his life from the flyers, although I don't think it's on there that he went to Michigan Tech, is that right? Yeah. Way up in, does anybody know where that is besides Bob?
Where?
A couple Michiganders, yeah, way up there on the UPA. But went to the Ohio State University for some graduate programs, and then has been in the Columbus area ever since. Are you a native Michigander or Ohioan?
Wisconsin, actually.
Wisconsin. Part of Wisconsin?
Right on the border with the Upper Peninsula, so Marinette.
Oh my goodness, okay. So you've been coming around this side of the lakes, but he's been stuck in the Columbus area for a long time. I think he's run out of insurance companies in the Columbus area to work for. He's worked for the biggie nationwide, and a lot of the smaller ones like Motors, which is now no longer called Motors. And Cova, okay. And State Auto, and now with Cincinnati Insurance Group?
Cincinnati Financial is the umbrella company.
Cincinnati Financial, okay, in the Cincinnati area, but he lives in the Columbus area, the Indiana area. And he's been here a couple times to talk about careers and opportunities in actuarial science and more broadly in risk management and analytics. Also on the board of directors, or whatever we call it, for the Masters of Science and Analytics program here too. So without further ado, give a warm welcome back to Dr. Bob Weishaar.
I went through my background, but so I do have a PhD in math, but to make it clear, you don't need a PhD in math to work in the insurance industry. I didn't even hear of actuarial science till very late in my academic career and decided that I wanted to stay in the Columbus area. So, but what's great is today there are lots of opportunities, whether you go the grad school route or whether you go undergraduate with some actuarial exams, lots of opportunities in the insurance industry, very data-driven, very technical. So we'll talk through a few of the applications. So I am the liaison for the Casualty Actuarial Society to Wittenberg University. So I do want to touch on just what is the Casualty Actuarial Society, what kinds of opportunities are there specifically there, and then I'm going to get into just a real life example of what actuaries do and how it's not. So it's much broader than maybe historically what we think of as the actuarial sciences. Brings in a lot of the broader analytics areas and business. Talk a little bit about the economic side, so really bring in the business considerations, which has been great over the last 10 years, really expanded from the kind of the pure back office technical work that actuaries do, and just rounded out with a few of the future considerations in auto, just to show kind of how interesting things are getting in the industry and what kinds of opportunities there are. So I'm from the Casualty Actuarial Society. We focus on property and casualty. There is also the Society of Actuaries that focuses on life, and we don't like each other. There's just all kinds of things going on. so if, yeah, if you ever go to an actuarial conference, you'll probably hear some presentation on what, kind of the latest in our relationship. And I mean, we almost got married a couple years ago. We almost became one and then, broke up. And right now we at least share the first 3 exams still. So in the actuarial world, you take exams to become an actuary. So you don't have to make a decision early on, but pretty quickly we want you to pick one route or the other. So I borrowed a few, there's presentations out there, so I borrowed a few slides from that, so these are more marketing material. There are great opportunities certainly on both the property and casualty side and the life side, but I am biased. So what is an actuary? So actuary is a business professional who deals with the financial impact of risk and uncertainty. So really what we focus on is putting a number, attaching a number to some future event. For instance, how much should we charge a 16-year-old? So 16-year-old comes to us for insurance, we got to figure out how much is this student going to cost us? Or how much should we charge for houses that are located near the coast? Now, when you get to near the coast, think about the types of things of considerations that might come up. Has every spot along the U.S. coast been hit by a major hurricane? No. Could they? Probably. And so we don't, like with this, we've insured millions of 16-year-olds, right? We have a pretty good feel for how one 16-year-old performs compared to another. But for how much should we charge for a house on the coast? Well, every point on the coastline is different, right? We don't have data. So we have to rely on meteorological models, lots of just simulation of what could happen, not really just looking at historical data as to what has happened. And how much money should we keep on hand to pay out claims, right? We have to come up with that expectation. We have to have money basically sitting in the bank in order to cover claims that might not happen until far out into the future, right? Most things like home and auto claims, there's a claim, most of those get settled pretty quickly, but there are certain states like in Michigan where there's, at least currently, there's personal injury protection insurance. There's no limit associated with it. So there are some people that they may have gotten into an accident 20 years ago and we are paying claims and we don't know what those totals will be. That uncertainty, there are decades left in trying to figure out, and that money we have to hold enough money so that we don't get caught in a situation where we can't pay out claims when they come due. Trying to think of, how do you explain actuarial science versus accounting? I kind of think of accounting, right, actuarial, you look toward the future. Something hasn't happened and we have to put a price tag on it. A lot of accounting's focus is on the past. How do we actually calculate what did actually happen? How do we compute that? I'm not an accountant and I may have offended accountants by putting it this way, but that's how I think of it, forward-looking versus backward-looking. So to work in the actuarial field, oftentimes you'll have a math, a computer science, or an economics degree, and actuaries are certified by taking actuarial exams. Insurance is very heavily regulated, so it is, a lot of times the state will mandate that in order for a insurance company to tell the state, yeah, we have enough money on the books, they want somebody who's been designated to actually look at that and say, yeah, you've done the math correctly. What's the challenge of insurance? What sets insurance apart from most industries is that we have no idea how much the product that we build is going to cost us, right? The product that we build are promises, right? And a promise to pay for claims if our customers have them. We do not know how much that costs us when we build it and when we sell it. We have historical data to estimate it. That's really the key challenge in insurance, and it requires lots of complex math. And just with industry changing drastically, we'll talk through some of the auto insurance implications. There's always new opportunities to apply not only insurance domain knowledge, but all kinds of other adjacent domains as well. The big areas, so if you're considering a career in actuarial science, big areas are rate making, so that's my focus over most of my career has been on rate making, so setting the price for the products that we put out there. Reserving is all about how much money you hold in order to pay the claims. Predictive modeling is, actually the reason that the Casualty Actuarial Society and the Society of Actuaries almost got married is because we saw the world of statistical modeling, predictive modeling, data science as actually being a threat. People were like, well, why should we hire actuaries when we can hire these, folks with these data analytics degrees? So we're like, well, wait, do we need to, what is the difference? And there's actually room for both, but now the actuarial societies are really focusing and kind of setting up a separate track focused specifically on data science and statistical modeling. Reinsurance, so as an insurance company, it's really that process of setting or figuring out how much money we need to hold is pretty tough. And we're like, we're 90% sure that we have enough money. Well, how do we protect against that 10% chance? We can actually buy insurance. That's what reinsurance is. When an insurance company goes to, typically a larger global entity, a lot of them based in Europe, and all the insurance companies go to them and say, hey, and they can handle it because they'll look, okay, so we take on this insurance company that has coastal hurricane risk, and we can balance that against this other insurance company that has earthquake risk in Japan. So they get these risks all over the globe, right? It's hard to insure one thing, right? That's the reason we buy insurance is because, right, why do I have insurance? If I get into an accident, the cost of settling that claim may be more assets than I have. So I have insurance. Same way as insurance companies, they all kind of get together like, ooh, some specific unique thing might happen, I might not have enough funds, so insurance companies all go to these large reinsurers to help cover those, kind of the tail of the risks that they face. And then ERM, enterprise risk management, kind of looking at all the different things that can happen, right? We talk about things like catastrophes, but there could also be, like if we're holding money in the bank, if there's a shock to the interest rates, right? If there's some stock market implications, right? We think we have enough money, but because of some, market downturn, that may actually impair our ability to pay out our claims. So enterprise risk management is really that broader looking at all the things that could go wrong, and how we can plan for that. This slide just kind of shows the range of options. So whether you like data or if you like interacting with people, there are, you can sit in the back office and never talk to another person, or there's consulting roles where you're only talking to people. At this point in my career, basically, I don't do math anymore. I basically write emails and create PowerPoint presentations. So I'm on the far side. Obviously, having had that background and doing some of the data, it puts me in a position where I'm able to have those conversations. So there's that, and then there's also from a stability. You can get into, there are roles out there where you're going in at 8, you're getting out at 5 every day, very stable. And then there's others, again, like the consulting roles where maybe, 1 week it's pretty normal, 40-hour week, but then maybe the next week you're at a client's office where you're with the client all day, and then all night you're spending kind of getting your presentation and your analysis together to present to them the next day. So lots, no matter really how you like to work or whether or not you like to, the degree to which you like to interact with people, there are opportunities. All right, so now I'm going to jump into just a very specific application of actuarial science. We're going to look at the pricing of personal auto. Anybody have any questions so far? Definitely, if you have questions, stop me. I'd rather more of a conversation rather than just me presenting. All right, so if we think about driver age and loss costs, right? How much is it going to cost us to insure drivers? What does this curve look like?
Starts big.
It drops, and then what happens on the other side? It goes back up. Okay, so you've all interacted with enough people, so you know how it works on both sides. So yeah, it has a shape like this. So to price personal auto insurance, we need to understand all of the risks that come to us. How much are they going to cost us, right? In this curve, right? So we all, you don't need that much data to see this popping out, right? You see the 60-year-olds costing us quite a bit. It comes down, and then it starts to go back up on the other side. So let's think about some of the other things that might be important when we're setting auto prices. Prior accidents and violations. right? Right. If somebody's gotten into an accident, it may be a good indication that there's the potential of them getting into another. How about a person's credit score? How will they manage their personal finances? Is that predictive as to whether they'll have an auto claim? It is, and so now it's pretty well understood. So 20 years ago, Progressive, probably the first company that really looked at this, and then it was kind of a shock. There was a lot of, again, insurance being regulated. The states were like, wait, that's not fair. How can you do that? Well, there's just, the evidence is just overwhelming that is predictive. How responsible a person is in managing their finances has a relationship to how safe of a driver, how much of a risk they are to take on. What about, so in insurance you have for auto insurance, you'll have the insurance to protect your vehicle if you get an accident, and that has a certain, right, your vehicle's only worth a certain amount, so that's kind of the max that it's going to pay out. But on the liability side, if you get into an accident and hurt somebody else or damage someone else's car, there you have a choice, right? How much insurance do you want to carry? So if you select higher limits, should you pay more or less? Right, if I want $100,000 of coverage versus $1 million, intuitively I should pay more for $1 million, right? There's that intuitive relationship. But what about prior limits of insurance? What happens if you come to me to buy insurance and I know, so people that look identical, but one of them purchased $100,000 of limits in the past, the other one purchased $1 million. Which risk is better? Which one? If they bought 100,000 or if they bought $1 million, so now they're going to, maybe they both select $1 million going forward, but one selected 100, one selected $1 million. The fact that they selected $1 million is an indication that they're more responsible. There seems to be something like the kind of that credit effect. And you find that, wow, if they've selected $1 million in insurance before, they made the decision to purchase more to protect their assets, that's actually an indication that they're a better risk. So it is something to think about when you're buying insurance. Yeah, you can buy the lowest limits that are made available to you, but by buying those higher limits, you may get a better insurance price in the future. So that's something probably 10 to 15 years ago companies started looking at. Yep.
Bob, you're talking about some of these other driver attributes that might matter. Are there some attributes that are just hands off? Like, I'm assuming you're allowed to charge different premiums for males and females. What if it involves race or ethnicity or religion? Is it illegal to use some variables, or is it just not good policy? Or
so gender is generally accepted. So most states will let you use gender when pricing for auto insurance. Some will not. There are some states that have said, nope, you can't use gender, even though we've got plenty of evidence that indicates there's a difference. They said, no, that's not fair. Yeah, race, religion, those, if there's not a statute, no company is going to they're just not going to, go down that path just because of the reputational risk, or it is explicitly illegal. There are some that are things like occupation or education, which it's kind of mixed. Companies have done studies to look at whether the education or occupation is predictive, and different states have different rulings on whether that's allowed or not. But that is a key consideration. So it's not just, throw all the data into a black box and see what pops out. In a lot of industries you can do, right? The pricing isn't regulated, but in insurance, it's definitely scrutinized. Whenever you add something new, finding a new variable to use, if it's predictive, this can be pretty powerful and profitable. But it's the first time anybody tries it, the regulators are gonna scrutinize it.
I just might add that my son got a discount for being a good student.
For a good student, yeah.
Good student,
yeah, good student is pretty common. So high school good student, but then whether you have a certain level of education beyond high school, that's the one that it's a mix. Annual miles. Intuitively, annual miles would be predictive, right? The more you're out on the road, although it may be, right, it depends what kind of roads you're on, right? If you're just out in, the country, depending on the time you're driving. Work schedule could be important. How about number of Facebook friends? Do you think you're worse if you have more or fewer Facebook friends?
More.
I think more, but I haven't done the analysis. I don't know anybody who has. But I mean, you can imagine. I don't know why you guys. Everybody seems to say more. Why do you think more? Just because more popular people are riskier?
More, yes.
What's that?
They go out and like do stuff more.
Okay. Okay. Or they don't. They have so many friends they can just stay home and not. But
yeah.
Right. Yeah.
It's a proxy for age.
Proxy for age. Okay. Yeah. Yep. Maybe distracted more, right? If your phone is indicating that you're getting, right? So it's all, companies are always looking, what's a new indicator of one risk versus another. So vehicle, right? The type of vehicle, the age. What about, so two people come to us with identical vehicles, but we find out that one of them had more owners. One of the vehicles had more owners than the other. One had always only been owned by one person, the other one, maybe 5 different owners. Which is worse? Yeah, right. You're not taking, right, the car probably wasn't taken care of if the owners were thinking, oh, I'm getting rid of this vehicle, passing it on to the next person. So this one, so that's an example of something that you could get from a Carfax report. Right, and that is predictive information, and that's actually something the owner might not even know. Maybe even a lot of times owner, you may buy a vehicle without getting that Carfax report. But having that insight, you could see the value of that information, both in making the decision about buying the car and also in insuring it. How about vehicle safety features? Do those make the cost of insurance higher or lower? So I feel like probably 10 years ago I was thinking claims costs were going to be coming down pretty drastically, but it just hasn't happened. And I think there's a couple of different reasons. One is vehicles are safer. The cost to fix a vehicle if it does get broken, I had a mirror knocked off that cost $1,000. I think you're right. How could that be $1,000? Right. So that it wasn't like just a regular. I won't. The type of vehicle, just any vehicle, the features that are on it are going to be costly. But I think the distractions have gone up at the same time. So it's hard to tell what's actually keeping the claims costs from coming down, right? We're thinking, oh, these vehicles are going to be so safe, they're going to come down, but people are getting more distracted today than they were 10 years ago as well. So all these forces that are, and it's, if you were a reserving actuary, think about, hey, how much are, future costs going to be? Maybe that expectation that things are going to come down, well, it just hasn't happened. So kind of resetting your expectations based on how things have actually played out. Things like, population density, of course, crime statistics, weather patterns, there's all types of opportunities to look at this data from other domains, and not only the current value of that domain information, but how is it changing, right? Crime stats is one thing, but are crimes getting worse or getting better in an area? And can you anticipate how those trends will influence your future costs, right? If you can anticipate, because insurance is regulated, it takes a while. If you decide how much you're going to charge, you have to get that through the state. So you need to know 6 months, maybe a year ahead of time, what are you going to actually charge there? By understanding the trends, you can put a price out in the market that is, adequate, but perhaps more competitive than if your competitors don't spot those trends. Traffic patterns, right? So around larger cities and the suburbs, there's all kinds of construction. Well, what's going to happen, right, to your loss costs in those areas, right? If you anticipate the population isn't changing, well, you're going to get caught, right? If suddenly there's more people packed into an area, the claims are going to go up. Or what about things like putting in a roundabout? So you had a stoplight, in a kind of a major congested area, or if you're putting in a roundabout instead, what's going to happen? Frequency at a roundabout does what?
Lower.
Yep, right, much lower, but roundabout. So what happens to frequency? Yeah, frequency goes up, right? Nobody knows how to drive in roundabouts, right? So you have more, you guys are young enough, old people like myself, we don't know how to drive in roundabouts. So what about severity? Severity definitely goes down, right? So it's much safer. How do they balance out? And it's interesting looking at the data, so watching what happens to the number of claims in an area and the severity, the total costs after a roundabout, it doesn't always go in the same direction. And it's not always clear what is it that causes it. What else is in the surrounding area that causes those changes. All right, so just to make it real, so typically an auto pricing rating algorithm will look like you'll have your policy premium, you add up the premiums for each of your vehicles. The vehicle, you add up the premium for each of your different coverages. And then coverages are things like bodily injury, right? If you get into an accident, you have to pay if they're injured. If you cause the accident, you have to pay for their property damage. Your own vehicle, comprehensive is it's sitting in the driveway and you have a hailstorm or something, right? You weren't in the vehicle, but it got damaged. Collision is if your own vehicle if you get into a crash. And then uninsured motorists is if you're driving, somebody else causes it, but they don't have insurance. Well, you may want to buy protection against that because it may be, if they don't have insurance, it may be difficult to get the funds from them to pay for your claims. So having coverage for that may be important. So then I just threw some example factors. So maybe you're paying 70% more for urban versus rural. Maybe you're paying 3.2 times as much for 18-year-olds versus your 50-year-olds, and so on. Okay, so you do all the analysis to figure out the cost of the different attributes, but now let's think about the economics of it. So let's go back to this this age curve. So just the front end of the curve, we know young drivers have higher loss costs than mature drivers. What happens if we decide, you know what, as an insurance company, I don't want to charge people for age. I'm not even going to use it. I don't think it's fair to charge younger drivers more, so I'm going to put in a pricing plan that does not use age. What happens in this case?
Well,
Who's going to come to us? We're going to get all the 16-year-olds, right? And all the older drivers are going to leave, so, right, our costs are going to go up. We're just going to have to keep raising the rates. This is called adverse selection. So on age, clearly we don't want, there's risks for not putting that into our rating plan. And that's why it's so valuable. Anytime an insurance company can find some new rating element that's predictive, they have a competitive advantage. By getting that out there, they basically do this to their competitors. They steal all the good ones, right? And then they push away any that are likely to cause more claims. So we know, so we have the estimate, maybe the 16-year-olds are 8 times as bad as the 50-year-olds. And we know we don't want to avoid it, but what happens if a competitor comes along and puts in something like that green line? Who is more like, oh, go ahead.
So do you find that the younger, more volatile drivers in this case clump to particular companies or organizations that provide lower rates, or is there an even distribution across companies for all the age ranges?
So if you look at different companies, certain companies will have younger drivers on average. Now, 16-year-olds are often, it's the parents buying it, so there's maybe less of a difference there, but I think you'll find, like once you're buying insurance on your own, I don't know, maybe most of you are still on your parents' policy, but when you leave and decide to buy insurance on your own, those probably price is more important, right? You don't have a lot of assets at this point to even protect, so you're not thinking about, right, is the insurance company going to take care of me? You're worrying about getting registration, right? You need to have insurance, so price is more important. So there is definitely a distributional difference. Yeah. So our competitor, so we said the red line's bad, so, do we stick with that orange line? What happens if a competitor puts the green line in? What's going to happen to us? Is that good for us or really great? They're going to steal the 16-year-olds? It's not really clear, right? Because who's out there shopping? Right, you guys might remember when your parents got the first bill, right, because you were driving, and whoa, right, that's a shopping thing, right? That causes them to go out. So if we're charging the yellow price and our competitors are charging the green, they might get them when you're shopping. They're going to lose a little bit of money, but are you going to shop after that? Most people are lazy. You have to shock them into shopping. So actually the one that's charging the green, they're going to get them when they're 16, they're going to lose a little bit of money, but in their mind they're going to keep them, right? And they're going to keep them past that spot to when they're actually charging more than I am with that yellow line. So what is the right amount to charge? In the past, actuaries have been focused on finding out that yellow line and then being like, well, this is what the numbers say. Do I have that on my, actually I'm just gonna jump to this slide right here. So in the past, actuarial group would do that analysis, kind of throw it over the fence to the marketing and sales folks, and the sales folks, in fact, this was just early in my career, so 20 years ago, I would do the analysis, I'd hand it to the sales and marketing folks, and I'd get one of two reactions. Either they'd be like, well, you're the actuary, so they would just implement it, or, well, you're just the actuary, you don't understand the business. I'd get one of those two extremes, and both of those are frustrating, right? Both of those are just assuming, well, all I can do is the yellow line, and now they have to figure out what that green line should be. Today, fortunately, it's much more integrated. It's analytics all along that spectrum, from figuring out the yellow line to figuring out which green line is actually going to drive the most profitable results for the company. That's all analytics, right? It's not the pure actuarial loss cost analyses, but it's the analytics required to understand if we're making good business decisions. So now, probably the first 5 years of my career was that frustration of handing things off and not really getting to work closely together with the business leaders. I would say for the last 15 years, it's much more integrated. Somebody else might have that profit and loss responsibility. They own the business, but I sit right next to them bringing the data and the predictive models necessary for them to make good decisions all along the customer value chain. Not just the pure loss cost price, but hey, how is this actually going to work in the market? So really, this is kind of the steps involved, right? So you have that market of all those risks out there. You want to acquire them, right? Get them into your set of policies that you have in force, and then you want to retain them. And there's a few different steps. First, it's figuring out what's the loss, the expense, how much does it actually cost? That's that yellow line. Step 2 is kind of the behavioral aspects. Well, how are these prices actually going to work if I put them out in the market? How are the customers going to respond? That's a pretty big area of market analyses and so on. And then finally, how do all the pieces fit together? So you have your insurance company, you have the data, and now you got to make a bunch of decisions. So a lot of my time is spent building models, kind of replicating the data of our insurance company, replicating it in an environment where we can do what-if testing. Where we can say, well, what happens if we change this price? Or what happens if we maybe change the underwriting rules and we stop writing a certain type of risk in a certain area? Or what happens if we appoint new agents? Or we do a new marketing initiative? How do all of those pieces fit together? So I can test it kind of in the lab. These are all the decisions I can make, which ones are going to work, and then make them in the real world. Of course, every time you estimate what's going to happen, the only thing you know for sure is you're going to get it wrong, right? But how wrong? That's the question, right? So you do it, you put it out there, you're like, oh shoot, we missed it on this one, but hey, we got pretty close here. Your model becomes better, but always replicating the real world in that analytics environment so those decisions can continue to get better. So really, what was missing historically, because insurance is regulated, it was all about just figuring out how much it cost for the product, right? Get the best estimate of cost. The concept of demand wasn't really present in the actuarial world. Every other industry, it's about supply and demand. That's how you set prices, but not in the heavily regulated insurance industry. About 15 to 20 years ago, companies in Australia, the UK, and Israel were probably the 3 big ones. They looked at the US market. They had built all these models of really that simulation and understanding the economics. And at first they were like, well, this isn't going to work in the US because they're so regulated. But they found out that companies were picking the green line from before. Right? The actuaries came up with the yellow line, right? That the 16-year-olds are 8 times worse than the 50-year-olds. But then they still do that next step of figuring out, well, what should we actually do? It might not have been the actuaries doing it, or maybe they consulted, but somebody was actually making the business decision about what the right prices should be. And regulators were allowing it. If the data said 16-year-olds are 8 times worse, if you went to a regulator and said, I'm only going to charge 5 times more or only 3 times more, the regulators were actually fine with that. because they got less complaints, right? People complain, right, when the parents get the bill, they're like, this is ridiculous. I've been with them for 30 years and now they're changing my rates. So, right, the regulators, they see that, yeah, this works. Customers are fine not paying that huge spike, right? Not paying quite as much and then it getting smooth. People still pay the right amount kind of over the lifetime of their relationship with the company, but it's not all at once. There's not these spikes. And so figuring out that, so those companies from other countries said, oh, whoa, there's lots of opportunities to apply these techniques. So the idea of looking at the demand side became much more common in insurance companies in the U.S. So it's really about price sensitivity. As you change the price, how many policies do you write? And this looks different for different customers. Now, what are some reasons why this graph makes sense, right? The higher your price, the fewer policies you would write. And then the lower your price, right? If your price is 0, in theory, everybody would be like, yeah, that's great. Why might those lines look different for different customers? Can you think of an example? Guys versus girls. Are they equally sensitive to price changes? Is one gender lazier than the other? I'm not going to answer the question, but is that a possibility where one may be lazier than the other? What about if you shop online for insurance, or if you go into an agent's office? Or if you went through the trouble of going to an agent's office, maybe you've already picked that you're going to go with them. Whereas if you're online, maybe you're searching for a bunch of them. There's a few reasons why this might look different. So it could be your own shopping behavior. Maybe you just have an affinity. You asked the question earlier about different ages go to different. Well, some people just naturally, maybe they grew up with a certain parents have always had State Farm, so they're just going to always stick with State Farm. Whereas others, it's all about the money, right? Right? They're in a position where they just need to find the lowest rate. That curve is going to be much steeper, right? So the steepness, a little change in price could cause their likelihood of saying yes or no to change pretty drastically. So so figuring out price elasticity is it's a value. It's understanding how people respond to price changes, both at new business and at renewal, can be useful in setting insurance prices. Problem is, it's very difficult in insurance to figure out what the slope of that line is. In every other industry, if you're selling Coke products, right, when you go to the store, every time you go to the store, the Coke products are a different price, right? Because they're testing. They're always trying to figure out, well, how much are people going to pay, right? They're always testing it, depending time of the week or airline prices, right? You've heard stories where, right, you go online to get an airline price, you go on, an hour later, it's like, well, shoot, it was just, right, it was this much, now it's jumped up. That idea of testing how people respond to prices is very common in just about every industry. In banking, I always like to read from the credit cards, you get these, the balance transfer, right? What's the percent for the balance transfer? Typically, my wife and I, we get them on the same day. I don't intend to use them, but I always open them up just because I'm curious. One of them is going to be 2%, the other one's going to be 3%. The next time it's going to be flipped around because they're testing those things. Now, they were smart about it. They would send us the same one so that it wouldn't be obvious that they were testing it. But those kinds of things happen. In insurance, you can't. I can't change the price for months. It takes me months to change it. So it's not like I can be running those tests. So insurance is difficult. To understand that, but there are still techniques today, and certain things are intuitive, right? You understand that when somebody adds their youthful driver to the policy, the price is going to go way up. So carefully studying that and understanding, hey, what can we do to help keep that customer through that transition? So the data is available, and it's just a little bit more technically challenging. Some of the future things happening in rate making. So has anyone heard of Root Insurance? So it's a startup. Well, it's over $1 billion company, so it's a very successful startup, but it was just a few years ago that it started. It's in Columbus, and the only way you can get insurance with Root is if you download an app on your cell phone, and you drive with your cell phone on you for a few weeks, and then they offer you a quote based on how you drove. So companies are doing this, but think about some of the challenges. So right, if I have a passenger in somebody's vehicle, are they going to count that? Like, say they're trying to estimate how many miles I drive every year. What happens if I only drive, every once in a while and I'm often a passenger in a car? They would have to distinguish between those. And it's pretty interesting listening to people talk about, like, things like watching a phone and if you've got in on the driver's side or the passenger side of the vehicle. Or they even talk about a fingerprint, right? How a person drives, the data, if you collect enough data, right, you could probably close your eyes with your friends and you would know which one was driving based on how, right, speeding up and slowing down. So it becomes clear pretty quickly from the data whether you were driving or not. And I don't know how Root does it specifically, but companies who have offered this, they'll oftentimes just give you options of saying, hey, you can go in and look at which ones they said you were driving, give you the benefit of the doubt. If you say, no, I wasn't actually driving this time, you can. Now, if you changed it every time, they probably get, skeptical, but so there is ways of getting that insight. So think of some of the things that might matter and how this might compare to some of those traditional elements we talked about earlier. So I mentioned braking, accelerating, and cornering. How does this compare to the use of aid, right? Both of my daughters have their licenses now, and I could see how this got smoother over time, right? Now, and maybe that some 16-year-olds get smoother, right? Their driving gets smoother more quickly than others. And that probably translates to being a safer driver. So, in theory, this is safer, right? This is better to estimate how safe a driver is than just age itself, right? Actually watching how they drive the vehicle. And prior accidents and violations, some of that is luck, right? Somebody might speed all the time and never get an accident or a violation, whereas somebody might just speed one time. They just didn't realize they were in a new area and they didn't know that the speed limit dropped and they got caught. You hear stories like that. So today we do use prior accidents and violations to charge for insurance. People could argue that it's not fair. It's not great, but it is predictive, so we use it. But again, if we could watch exactly how they're driving, whether they're speeding, right? So, Google now, when you use it to give you directions, oftentimes it'll tell you what the speed limit is as well, right? So we know how fast you're going, we know what the speed limit is there, so we could calculate, instead of using prior violations, we could just calculate how often are you speeding, right? What percent of the time are you going over 75 miles an hour? Those kinds of metrics. What's great about a phone too is distracted driving, right? We can tell if other things are happening with the phone. Now, of course, there's the case where somebody's driving and their kid is using their phone. So again, those kinds of things, depending on what's happening on the phone, you might be able to make the assumption that, right, if some intense game is being played, okay, it's probably not the driver doing it. But so there are challenges associated with using this data, but again, Root, very successful insurance company that has figured out how to apply it. And then even more into the future, thinking about the automotive industry as a whole, changing car ownership models. So a lot of companies now, instead of buying a car, there's those monthly subscriptions where you can just trade in the car every, and within that subscription price, the insurance is built in. So it's not the insurance companies themselves that are selling directly to a customer, it's the car manufacturer that is basically selling the insurance. Now I'm certain that they're doing something like reinsurance, or they have another insurance company behind them, but it's a different kind. Instead of pricing each individual policy, you're charging GM versus Honda as far as how they administer their program. Use of personal assets and business applications. So Uber, right? That changed even how we write the contracts, right? Maybe. There was always probably been examples of people, they have a vehicle and they do things with it that's more business oriented. So it's a personal auto, but they, maybe they rent it out or do some things like that. But today this is very common. So even how the contracts are written has changed, changed pretty dramatically. And autonomous vehicles, all kinds of things happen. So who's at fault, right? Is it if the car is programmed to do something, it'll be a long time before all the vehicles are completely controlled by by the car itself rather than a human driver. But there's this fuzzy area. When something does go wrong, who is at fault and who's going to cover that? And if it's today 16-year-olds getting into an accident, those are independent events. So traditional, statistical techniques are fine, right? It's a 16-year-old getting in a car accident, here versus in Columbus. There shouldn't be any correlation between that. But once autonomous features become more common, the possibility of hacking, suddenly you can have lots of accidents happening at once. Insurance companies don't reserve with that mindset, right? We do, right? If you've taken the statistics courses, independent, right? Your normal distributions, if all of a sudden all of your vehicles can get an accident at once, that's a tail event that we've never contemplated. We don't have enough money to pay for everybody getting into an accident at once. So, but that becomes more, at least a possibility when there's more of these connected autonomous features. Ethics is a huge deal now. If a car is autonomous and right, sometimes there is a choice. Do you swerve, right? If there's a pedestrian in the way, do you swerve? Maybe there's a pedestrian on the side and there's an oncoming car. The car has to decide what's going to get hit in that case. Well, right, obviously lots of ethical, when you think of the other domains that are related, there's the pure kind of back office number crunching, but understanding trends in how the industry thinks about certain things, and as folks with lawyers and others weigh in, what is that going to do to how these systems are designed? That all comes together as an important part of our pricing and our reserving practices. And then humans, just sharing the road. I have a car now that has adaptive cruise control, and this idea. Now I see what happened when I put it on adaptive cruise control. All that means is that people are just going to keep getting in front of me, and my car is just going to keep going backwards. So can you even adopt some of these things until all of the vehicles have these technologies? So lots of interesting things for the future. Okay, so I guess I left 2 minutes for any other questions. So yeah, lots of opportunities in the industry, both pure actuarial science, graduate degrees, things like image mining, natural language processing, so many different opportunities to apply, sophisticated, data analytics. Yeah, definitely. If anyone has any questions about the industry, actuarial science specifically, I work at Cincinnati Insurance. So if any questions about the company, I'm happy to talk now or after. Yep.
So you talked about Root, but a lot of other companies you can sign up to have like a beacon in your car.
Yep.
Is that kind of a good way? I always thought of it as a good way for somebody to just signal that they think they're a good driver. If you're willing to sign up to that program, you're probably on average a better driver. So that's why they were kind of willing to give you at least a zero discount, but possibly a big discount.
Absolutely. That's called the halo effect. If somebody says that they're willing to put a device in their car, willing to say it, and then also because the device is there, they're going to be a better driver. So right, companies will fund their programs that way. It costs money to put those in, but we know that people are going to adopt it. Their performance is going to be better. So, yep, that's exactly right. Yeah, most companies are experimenting. 10 years ago, even longer, I would have guessed by now that's how insurance would be priced, is with telematics devices or cell phones. It has taken much longer than I thought. In fact, I think smart home technologies are probably even overtaking that. So understanding how often the home is used, if there's people in the home, right? That your risks of by watching what's going on, or sensors, right? If there's leaks in the pipes and things like that. So lots of new sources of data to help with pricing of risk even outside of the telematics space.
Bob has graciously agreed to stick around for a little bit here in case anybody has any specific questions they want to ask him personally. With that said, let's thank Bob for